one for our Q1 20 minutes coffee. As usual, with my dear friend and specialist, Neil Williams. Very good to see you, Neil. How you doing? All good?
Very well, my friend, and good to have coffee with you again.
Lovely tie color. Did you dress this one because today we have Italy soccer team playing, so that was like a remembrance, I guess.
Very astute of you, my friend. It was really just to congratulate Italy on their rugby performance in the Six Nations Championship in February and March. Excellent wins against Scotland and England, and I'm just so relieved that we managed to beat you. But a fantastic performance by Italy. So this is in honour of Italian sport right now.
Touche. I appreciate. I still try to ask to my dad if he knows about rugby, but he says, "What? What's that? Rugby? What is it?" This is how famous the rugby team is in Italy, you know. But today we have like the football guys for the another championship that you know very well. With you as usual, Neil, I use. Please allow me this term. Your the expertise in economics. We talk about what's going on in the market every quarter. And actually, I would like to kick off asking you what has been changed like for the last time that we spoke. That was like for the December Q4 2025 chart that we had. Till today, a lot of things in the world happening, but what are the repercussions on the economic side?
Well, yes, there's a lot to discuss. Let's start with a quick refresher. What you and I discussed before Christmas last year, when the world was obviously troubled, but we didn't have at that stage a Gulf War to consider. The situation now obviously is fluid, but if anything, it's the events since then have probably sharpened my views for the rest of this year. We were talking about three themes which I think are still relevant. The first one is building political and economic distrust, especially into the US midterm elections coming later this year. The main route or main channel that we assumed in December was from tariffs and retaliation, which in my view are still relevant and are not yet fully priced in by risk assets. But because central banks are wary of inflation expectations rising, they would frustratingly be slow to respond by cutting rates. So to those investors who were expecting a rerun, for example, of 2009 and afterwards of ultra low rates, would be disappointed. Christmas, which is still relevant, is that growth for governments will supply. So despite the tough talk by governments looking to tighten what I call the fiscal screw, even in this high debt world, those governments would fail to do so. And as a result, putting those things together, it would give us all the problems, the unintended consequences that would be linked and build up and linked really to storing an increasing debt pile. And all that means for managing that the road. So in essence, the themes we talked about for Christmas, if anything, since then, have become, in my view, even more relevant.
Okay, just to recap, I don't know if we had some technical issues because I missed you in the you mentioned about the first one. It was economic distrust because at that time was tariff talking. Then the increasing of the debt side. And then I missed one.
Oh, the middle one was really stagflation. Tariffs contributing to either a shortage of certain goods or a perception that goods would be in short supply. And then the frustration for central banks is that are they then allowed to cut interest rates at a time when inflation expectations are building? That for them would be difficult. That was one of the major themes we discussed.
Indeed. So you are also, you know, from December till today, as you mentioned, many things happen. Actually, in all of this major elements or drivers, no, that you mentioned. The tariff side, you continue to say that they are still relevant, but also on the other side, we saw that the Supreme Court released a sentence against actually the tariff price. So actually, do you still believe that there is, of course, a huge backlog? Because I mean, you don't switch the thing, or you don't change the thing in weeks. So this is still very relevant for you. Then the stagflationary side. I recall I was watching a UBS chief economist release. Actually, last year they were talking about much more. We've been talking a lot about deflation instead of the stagflation side. So there is this huge shift. What are, at the end of the day, in your opinion, the drivers that have been changing so far? You mentioned one of them, that actually it's what happened in the last weeks, no? The new war that right now we are experiencing, that is the Middle Eastern one. So this is the major one of the major elements that have been changing your view. That's correct?
Well, I think there are three fairly strong forces that lead me to the S word, stagflation, or some people are even calling it Trumpflation. And one of them is tariffs, which I'll come back to perhaps in a second. But maybe the overriding one at the moment is the direct or indirect result of what's happening. It's not just through higher oil prices, of course, all the gas and derivative commodity prices that go into everything that we consume. If you remember, prior to the start of the war, various forecasts from the IMF, from the OBR, etc., were looking for inflation globally this year to either be constant or fall. It seems and started again, and it seems to me, I suspect a rule of thumb will be, compared to those old forecasts, we might now expect, as a result of the Gulf War, growth to be probably halved, and headline inflation rates probably to be doubled compared to previous forecasts, almost regardless of the duration of the war. And I was expecting you, Antonio, to ask me how long did I think the war was going to last, and of course no one quite knows. But what I come back to is that this stagflation would arise almost regardless of the duration. Why do I say that? Well, clearly events are still fluid. We're flicking from various ultimata on either side to pauses in certain strikes. But it seems to me that even if the conflict were to end tomorrow, installations and pipelines will take months or maybe even years to repair, at a time when oil reserves are already tested. And if I can throw some numbers at you in terms of how finite is the oil, which again is a very big subject, I've been looking at the IEA, the International Energy Agency numbers, which, as you know, have just released some of their strategic reserves to help to smooth prices. And the 400 million barrels that they say is immediately available is just over a fifth of their total reserve, if you include reserves held by corporates allied to those countries. So you've got a total strategic oil pot of about 1.8 billion barrels max. Now they're looking to fill the shortfall of about 400 million barrels caused by the main Gulf states switching off supply. Now they normally produce between them about 20 million barrels a day. So it gives all these numbers, but what I'm getting to is, on the basis of these numbers, if Gulf production runs dry, which it's pretty close to at the moment, then the initial release of strategic oil reserves would probably take us little more than 3 weeks ahead to fill that gap. In other words, as we sit today, Antonio, that takes us to mid or the end of April, depending on when they started to 0.4 billion barrels of what's available, would therefore on that basis take us probably to mid-year or July before that strategic pot was exhausted at the same level of demand, in which case that's a long time ahead of November's US midterm The point I'm getting to is that Mr. Trump has every political reason to cut this war short. As you know, two of the biggest drivers of US voting into elections tends to be the gas price and also the S&P, neither of which at the moment obviously is looking too favorable for US growth. The uncertainty now for markets obviously is whether it's now out of Mr. Trump's hands, which with other countries now being dragged in, I suggest it is. So I guess the point I'm getting to in macro terms is that whether you believe the conflict will last just a few more weeks or drag on for months ahead, the impact on prices and the perception of shortages of goods, certain goods, probably will be as strong and have the same impact on growth by reducing it and on inflation by increasing it significantly. And that for me is one of the three main drivers of stagflation that we might expect.
Got it. Pretty tricky, indeed. Today, again, another strike of another oil tanker of the Kuwait. So this is it's one brick on top of the brick in a negative way of this new shock, no, that we are experiencing. You mentioned about a couple of, I mean, the major drivers at the end of the day definitely is the war in terms of this stagflation. But do you think that there are other drivers that are moving like the needle towards a stagflationary environment?
Yes, I do. The second one perhaps is the inevitable follow-on from higher energy and related prices, which of course is holding down confidence, demand, growth until supply gets online. And as you've guessed from what I was saying, I doubt that's going to be imminent. So the second stagflationary force is just simply lower growth. And the third one, coming back to your very relevant question earlier on, is that are tariffs out of the picture? I fear that they're not. And that's the third stagflationary force. The US's effective tariff rate on its trading partners is still quite high. It's just under 20%, despite some of the climb downs that Mr. Trump has already made on some selected tariffs. And you're quite right to say that the Supreme Court, since we last met, has questioned the legality of some of these tariffs. But as I understand it legally, Mr. Trump has what's known as Super 301 in his back pocket, which is it's Section 301 of the 1974 Trade Act, which sounds very dry. But what it does is allow the president of the day to enact trade restrictions, tariffs against any country he or she believes is acting against the US's interest. That's regardless of Congress. Congress's go ahead. So the best previous historic example of this, the test case, is probably going back to the Depression after 1929-30, where, if anything, it ended up into a bit of a barroom brawl. There were no real winners from tariffs and retaliation. And remember, this time round, the world is twice as dependent on trade than it was 50, 60 years ago. If you add up a country's total exports to its total imports and divide it by its GDP, the size of the economy, the losers from tariffs are not the US or China, the big guns, whose trade dependence is relatively low or falling at 22% or 35% respectively, but instead the small, relatively open economies, especially Southeast Asia. Some countries in Southeast Asia, like Thailand, Malaysia, have trade dependence ratios %. So it seems to me that were tariffs to remain in place, and this is when the fog clears from the Gulf War, the flow back to the US and China in turn may be irresistible. So again, there are three forces for me that suggest that stagflation is going to be with us.
Definitely, and actually touching on the Southeast Asia point, a very relevant point that you just mentioned, not only from the tariffs looks like, because right now also from the closure of the Strait of Hormuz, so also on the oil side, Myanmar and this country in Southeast Asia are already under huge stress for the reserves, a usage of fuel on their daily life. So I think that also we're going to see even more issues for their economies going forward. But now, Neil, in the last minutes that we have, I would like to touch actually on the central bank side. You mentioned something at the very beginning, briefly, of the action that have been put in place from some of the biggest one, of course, the one that are super relevant for the rest of the world. Can actually you go retouch them and try to understand also what, in your opinion, could happen, considering all that we've been talking? What kind of bullets still they can have to somehow handle the situation?
Well, yes, and those central banks have been slow to build these world external shocks into their own forecasts for different reasons. First of all, tariffs, and now, of course, they have to deal with higher oil and commodity prices. And central banks usually produce forecasts quarterly, not monthly. So again, they will not be up to date in terms of the numbers that, or we will not be up to date in terms of their thinking. Taking central banks first. Many central banks, of course, now have inflation targets to protect, many at 2%. The US is slightly different, having a dual mandate. So they're going to have to talk tough. Already, money markets have flipped from expecting a couple of rate cuts this year in the UK and the US to then beginning to suggest the next move could be up rather than downwards. And we've had some fairly vague comments from the US Fed so far. But from experience, central banks will not want to raise interest rates if they're facing the wrong type of inflation. And what I mean by that, it's cost inflation through energy prices, etc., which hit us in the pocket, rather than good old-fashioned demand inflation. Do you remember that, when it was driven by consumption and we all used to get paid to compensate for inflation and maybe more? It's the first sort, cost inflation, which is going to prove more difficult for central banks. Also, central banks, remember, now are looking over their shoulders regarding their own independence, especially after 12 years of quantitative easing after 2009. And many central banks that took out QE are experiencing losses, sort of balance sheet losses as a result of their bond holdings. And added to that, of course, in May, we can look forward to a new chair at the US Federal Reserve, who will be wary of the national president breathing down his neck. So central banks may not be as quick to cut interest rates as some of the optimists hope, but I just very much doubt that they will be wanting to hike interest rates, because the type of inflation is driven by things that hit us in the pocket. They don't fuel our spending. So what they will do, I think, is look through it. A good example, if you may remember, is in the UK back in 2011, when we had rising energy and food inflation. And the governor of the Bank of England, Governor King at the time, did not raise rates, even though the inflation target, the inflation rate at over 5%, was 2.5 times its target. Either way, it seems to me the bottom line for governments is that central banks are not going to cut interest rates anywhere far or fast enough to give governments the growth they need to, first of all, please us electorates, or to reduce their debt. So on the fiscal front, we come back to a subject that perhaps we should review again later on this year, Antonio, which is government debt. To me, it's going to be swept under the carpet, especially if governments, especially in Europe now, need to raise spending on defence. It'll be financed, if necessary, by printing more money, QE, or they'll call it something else. And all the government debt problems will be sort of swept under the carpet to trip up policymakers and their successors further down the line. So I suppose putting all these strands together, to sum up, apologies first of all if I'm sounding not too upbeat. Probably a result of Wales not having done very well in the Six Nations, unlike Italy. But the S word to me seems likely to be with us for a lot of this year, and to lie fairly heavily. It'll be a headache for policymakers, for central banks wanting to cut interest rates, for governments wanting to see growth, but as investors, it'll be plenty to keep us busy into the summer months.
Got it. Let's just remind that for S word we are talking about stagflation, right? Not something else. But yes, on the other side, I appreciate. What's your view on? We know that the Fed chair is ending the contract. No, let's say the mandate. We know that already there is someone else that already been put by Trump once again, because we have to remind that Pavel was nominated by Trump in the first mandate, isn't it? So this is something that I realized and I discovered actually today. So that's the reason why I'm telling you. I didn't recall like 14 years or 15 years ago what's happened for the Fed chair. But what is your opinion for the new? And as you know, you mentioned something very important: independence. So do you really think that with what we are seeing? How the Trump administration has been acting so far is going to give this famous, a very important element that is independence to the Fed going forward.
Well, that's
Briefly.
right, and that's right. And independence is going to be paramount, not just for economies, but for financial markets, because obviously since 2008, when the US started QE, 2009, when some other countries did, the longer the QE went on, and it went on for about 12 years, the greater the impression was that central banks were doing fiscal policy for governments. If you like, central banks had become the monetary departments of government. And there is a very good a real life example of a country that started its own QE over a quarter of a century ago, and even now cannot switch it off. And that country is Japan. And the US Fed and other central banks won't want to give the impression they are becoming told what to do or influenced to a greater extent by governments. And on the second point, let's remember that governments have to be slightly careful here, because in the US, Mr. Trump has been quite forward in putting pressure on Jay Powell, the governor, the chair who's stepping down at the US Fed, to cut interest rates faster, but he has declined to cut them very quickly. Mr. Trump has to be careful, because if financial markets, bond markets, start believing that governments are taking ownership, if you like, of central banks, they will probably require a higher risk premium on US debt or on other governments' debt. There'll be less confidence in the credibility of the institutions. And in the US, this is particularly dangerous, because if you get significantly higher bond yields, in the US, they tend to be a big driver of US mortgage rates. And so a government in the US, for example, that puts undue pressure on central banks risks seeing higher bond yields and thereby seeing an unhappy electorate facing higher mortgage rates. So governments have to be, not just in the US, but generally have to be slightly careful to allow central banks to do the jobs that they're set up to do, which is monetary stability.
Yeah, indeed. Definitely we can keep going and talking even more. You brought also other very important topics that I would like to discuss now, such as like the Bank of Japan. Now Japan market, it's looks like it's rebooming, right? Somehow also for the political side, because they have stability. Looks like they have stability. But this is going to be like another topic that we're going to discuss in the next quarter. We had a lot of juries as usual. I really enjoyed it, and I'm very much looking forward for our next chat, Neil. Hello? Yes.